Wall Street goes on one of the wildest roller coaster rides in its history. Can India capitalize on the reciprocal tariff pause and why the sell off in Adobe is unjustified? This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. We're back on a Tuesday time. Was not sure whether I would make it because I was not feeling well yesterday. I thought maybe, oh no, back to Wednesday recordings again, but nope, just in time recovered. And I am back at our usual time on Tuesday. And my God, what a week it was. Did you guys check your portfolios or you decided to give up on it once the market sell-off happened last week? I don't know what you guys did, but what an exciting week it was. Some call it exciting, some call it nerve-wracking, whatever it was absolutely, like I said, it was one of the wildest roller coaster rides for Wall Street in its history. I mean, I did tell you guys at the start of Trump 2.0, way back in January, I did tell you guys very clearly that volatility will be the name of the game. But what we are witnessing, ladies and gentlemen, is something that is unprecedented. It has made even the so-called smart money hedge fund managers, I mean, that's what we call them, smart money managers, it's made them sweat. Even when their bets have been right, victory has been very short-lived as markets zigzag in a way that I just have to repeat the word is unprecedented. One day you make your bets, you get it right, but instead of getting the directional bet right for multiple days, the direction changes quickly inside 24 hours, and it's got everybody, the smart money, even government officials. There have been claims of insider trading, all sorts of things have been happening. Just goes to show what an unprecedented times we live in. Obviously, tariff developments continued to dominate headlines in the week gone by, but with earnings season officially kickstarting as well last week, investors are in uncharted territory, especially since the question now becomes where the focus needs to be. Do we need to continue to focus on tariffs? How much focus should we give tariffs, especially at a time when earnings season are happening in conjunction? If the week gone by was any clue, the earnings season barely kicked off. So tariffs did get the headlines, but if the week gone by was any clue, then investors, ladies and gentlemen, like you and I, are in for a very wild ride. We better buckle up. We better get ready for an absolute roller coaster of ride. And I don't even like roller coasters, so this is a conundrum that I'm in. Whether it's a real roller coaster or financial one, still doesn't I'm still not enjoying it one bit. But hey, makes for great entertainment, right? I was telling my friends, podcast script writes itself. I don't need to do much. Thank you, Donald J. Trump. Anyway, once the dust settled, all three indices ended the week in the green. Last week was red. This week in the green. Already some signs of roller coaster there. Dow gained 5%, S&P 500 5.7%, and the tech-heavy Nasdaq jumped 7.3%. Like I said last week, ladies and gentlemen, this is not a typo. Yeah, this is not. I had to double, triple check it even before recording. I had to quadruple check it just to make sure that these numbers, 5% for the week, 5.7. Last week it was down 9%, 8%, all of that, right? So this week it was up, gaining 5%, S&P 500 jumping 5.7, tech heavy Nasdaq jumping. So this is not a typo. It's the funniest story or the funniest cases or the most interesting cases that the weekly finish simply doesn't tell the full story on what investors witness. It doesn't tell full story on what a roller coaster ride it was for investors. So without further ado, let me first quickly welcome you to the first segment, the Doctor's Weekly Snapshot, and explain to you why week number 2 in our post-liberation day left investors with more questions than answers. I mean, sometimes I feel, as I was writing the script, maybe I should have recorded last week's episode on a Thursday and rather than Wednesday, because it could have allowed me to take you through what I assume was the first of the many roller coaster rides the U.S. markets are likely to go through this year and for the foreseeable future, at least. I mean, as long as there is concrete certainty with respect to Trump's 2.0 tariff policies, we're in for a wild ride. And so buckle up is all I can say. Now, before I give my take on what was, as I repeatedly say, one of the wildest weeks in Wall Street history, let me first take you through some specifics. So last week, I told you that President Trump unveiled his much-awaited reciprocal tariffs. And they came out to be a lot harsher than expected and were calculated based on some twisted formula where, like one of my closest friends and my former boss puts it, Trade deficits with the US, along with the value added tax charged by each nation, were the main inputs to determine the tariff rate. So it was not necessarily a tariff rate, it was based on trade deficits. He was rightfully corrected me last time saying, Vinay, you got to get this right. So here I am making it right. So hope I did tell you that I'll acknowledge you, sir, and so now I'm doing exactly that. So so it's basically the trade deficits with the US along with the value added tax. That kind of some bizarre formula was made on the tariff rate, on the net tariff rate that a nation puts on the US. Now obviously the tariffs led the reciprocal tariffs. The initial reciprocal tariff announcement led to a massive sell-off on Wednesday. But what happened was on Wednesday, within hours after episode 122 was released, I had nothing to do with this, ladies and gentlemen, but it sure as well made me wonder why on earth didn't I push the episode by one more day? Within hours on after this episode was released, and within hours after the initial reciprocal tariffs was announced, President Trump's social media posts, first encouraging stock purchases, then announcing a 90-day pause on some tariffs with the exception of China, triggered a historic rally. And by historic rally, I mean, I think I'm underplaying it. Here's some context. NASDAQ surged over 12% on Wednesday, marking its biggest one-day gain since January 2001. S&P 500 and the Dow also posted their largest single-day increases since the 2008 crisis and March 2020, respectively. Much of these gains were reversed the next day. On Thursday, much of these gains were reversed as trade tensions with China escalated again, with the tit-for-tat tariffs by both nations leaving the world in a pretty uncertain place, especially since, unlike last time, China has absolutely shown zero intention of coming to the table to negotiate. So the question investors then ask themselves is, what prompted this bizarre U-turn from President Trump? I mean, I don't find it surprising or bizarre, but I'm phrasing it as bizarre because once he released the reciprocal tariffs, pretty much everyone within the administration was saying that there would be no going back from this. Okay, there would be no reversal of policies, nothing whatsoever. Within 24 hours, the U-turn happened. So U-turn essentially can be attributed not to the stock market meltdown, but actually to the bond market meltdown. Yields started to, remember, there is an inverse relationship between bond prices and yields. Yeah, so as bond prices go down, yields go down, yields go up, and vice versa, right? So here's what happened: yields started to spike even as stocks crumbled, which is particularly very, very peculiar. Rarely happens because normally, investors flock to bonds as a flight to safety. So normally bond prices would go up, yields would come down, and that's normally a sign of recession, where even as stocks crumble. Here, what happened was it was an entire sell-off. Whatever American was being sold off. So it was U.S. stocks sold, U.S. bonds sold. All kinds of things, all kinds of weird things was happening with the markets, but it's the bond markets that caught President Trump's attention. So basically, yields started to spike even as stock crumbled. So not only were the risks of recession going up, but the fact that the government's borrowing costs were also going up at the same time was too much for President Trump, and he backtracked. Simple as that. Furthermore, the market turmoil combined with a flood of calls from executives, lawmakers, and foreign leaders created mounting pressure on the White House to reconsider the tariffs. In fact, JP Morgan Chase CEO Jamie Dimon and other business leaders warned of recession risks and urged a pause. And President Trump later on even acknowledged that he was listening to Mr. Dimon's interview on Fox News, and that did play a role in his decision to reverse the tariff. So 90-day pause on tariff, check. On top of that, we also got a cooler than expected inflation in March, which was a surprise to many. Check. Time to rejoice, right? Basically, everything's going in the way of the market's direction. You've got a 90-day pause, inflation coming in cooler than expected. What could possibly prevent any happy news? Well, I would say not quite time to rejoice yet. And here's why. Inflation may have come down in March, but the data simply doesn't account for the reciprocal and the other tariffs. Remember the steel and aluminum tariffs? Remember the 25% auto tariffs? Remember the tariffs on China that continue to stay, 145% tariffs? All of these that were announced in April 2 and beyond were not captured in the March inflation data. And the direct impact of all of these tariffs would only be seen in the April's inflation report, which will obviously be released next month. No surprises then that the Federal Reserve welcomed the March data, but policymakers and economists expect tariffs to reverse recent progress on inflation. The Fed's own meeting minutes highlighted concerns that inflationary pressures could prove more persistent due to these new trade policies. So it's not quite time to pop open that champagne bottle yet. Second reason why the tariff related uncertainties, ladies and gentlemen, are far from over. If you think that you can peacefully rest for the next 90 days, then I'm sorry, but you're wrong. Economists warn that the 90-day pause does not resolve the underlying issues. The uncertainty is likely to dampen investment, growth, and inflation expectations. And we also don't know whether President Trump's reversals showed his pain threshold or whether it was simply a one-off. In other words, there is absolutely no guarantee that President Trump will be constrained by market actions in the future. He could very well be like, you know what, screw this. I'm going to go, I don't mind the risk as long as I get better trade terms. So probably planning to, he could very well risk further turmoil to secure better trade terms. The tariff zigzagging has also made the US consumer absolutely fed up and terrified. The University of Michigan's Consumer Sentiment Index, for instance, which was released last week, fell to 50.8 for April from a 57 in March. This is the second lowest reading in the index's history, dating back to 1952, only slightly above the all-time low of 50 set in June 2022 during the post-pandemic inflation surge. The survey period coincided with 2 weeks of volatile tariff news. President Trump announced sweeping new tariffs on April 2nd, then paused most of them except for China on April 9th. Americans now expect prices to surge 6.7% over the next year, the highest inflation expectation reading in 44 years, reminiscent of the early 1980s. Confidence in the labor market is also eroding, with share of consumers expecting unemployment to rise in the next year at its highest since 2009. And we all know what happened in 2009. Finally, the combination of rising inflation expectations and weakening job prospects raises the specter of stagflation, a term I never thought I would use, especially when when we all saw how the Fed was doing when it comes to taming the inflation beast. So stagflation is nothing but stagnant growth with high inflation. Longer term, 5-year inflation expectations have now risen to 4.4%, up from 3% a year ago, well above the Fed's 2% target. Economists warn that if consumers and businesses expect higher inflation, it can become self-fulfilling as both wages and prices are pushed up in anticipation. Bottom line, the reversal of the reciprocal tariffs on every country except China was welcomed by the markets with open arms. On top of this, over the weekend, President Trump also indicated that he might roll back the 25% or he might pause the 25% on auto tariffs to allow car makers time to shift their supply chains back to the United States, whatever that means. I mean, how much time? God only knows. It's not a switch of the button, right? It's not a switch of a button and then suddenly factories in US. Switch of a button, factories in US. Not like that. It's not easy. So I don't know what he means by giving them time to shift the supply chains back to the US. I have no idea. Add to this the tariff exemption on a range of technology products, including computers, tablets, Apple Watches, and semiconductors, would also be exempt from new tariffs on Chinese goods and a 10% tariff on all US imports. And one can easily ask why uncertainty still persists in the US markets. This is because, ladies and gentlemen, the game is far from over and you are dealing with an individual who makes the decision on a whim. Just look at the number of executive orders he has signed since his inauguration day. He can make the decisions on a whim without doing any preliminary analysis. At the same time, once he realizes that things are going indeed horribly wrong, he changes lanes so rapidly that creates total chaos and confusion literally among everyone. You take any category of individuals, it's the chaos and confusion is there. Look, at the end of the day, the most likely scenario looks like it's heading towards Trump versus China 2.0, with the only difference being it could be a hell of a more brutal trade war than last time. For other countries, it's a simple case of bringing them to the table and ensuring that the trade deficit narrows to a point that benefits the United States, according to President Trump's calculations. As long as he feels it benefits the United States, That the whole point is to bring them to the negotiation table. At least that's what it looks like right now. As I speak, things could be changing. You haven't seen any breaking news yet. Could very well be changing. For this to happen, for the countries to bring to the table and for them to agree to the US's trade demands or trade demands or requests, the Trump administration is more than willing to be as dynamic as they can get. The issue is that with all this dynamicism within the Trump administration when it comes to trade policies, is that it leaves everyone hanging. And as far as markets are concerned, it's the perfect recipe for the name of the game, volatility. The question then becomes, what should long-term investors do in an environment that feels like a drive down I-95 and more like, that feels less like a drive down I-95 and more like navigating New York City rush hour with Waze constantly rerouting every 30 seconds. This was a quote by Rob Citron, founder of the $2.5 billion macro hedge fund Discovery Capital Management. I thought I really liked the quote and it fits the narrative. What should long-term investors do? My take remains unchanged. I'm not as volatile as President Trump is. I mean, at least not when it comes to markets. I don't know whether when it comes to my career and life choices, I'm not sure whether people might disagree on that. But my take, as far as the markets are concerned, remains the same as last time. Be patient, be calm. I know it's easier said than done, but that needs to be the mantra, in my opinion. Look at your company watch list or wish list. Start putting capital to work in high quality names, little by little. You don't need to go all in. Don't need to go all guns blazing. Start by little. Dollar cost averaging is what I would say, because we might be in for a wild ride, ladies and gentlemen, but high quality names would still come out on top. They always come out on top once the dust settles. Not even President Trump can change that narrative. And with that, as I take a sip of water, let's head to the next segment. The doctor goes home. And as promised, impact of reciprocal tariffs on the Indian economy is going to be the theme for this week. I did tell you when I talked last week that I was waiting for the RBI's decision, studied the RBI's decision a little bit more, and then get back to you. So looks like Indian investors can breathe a sigh of relief. Yeah, I mean, I wouldn't be too comfortable, but in the space of a week, the whole scenario has changed on its head. From what was expected to be a 26% reciprocal tariffs for the 90 days, the next 90 days, let's say that right now, that for the next 90 days, this could change by the time the next episode comes back. Such has been the uncertainty. We could very well say, screw the 90-day policy, we're putting reciprocal tariffs back. But as things stand, at the time of recording, the 90-day pause that the reciprocal tariffs, on India got, and the fact that they would stay at a baseline rate of 10%, because of, like I said before, President Trump reverses earlier plans of imposing reciprocal tariffs, with the exception of China, of course. Don't forget, it's 145% imposed tariffs on China, not 125%. And China has put on the US 125. So it's 145 versus 125%. So tit for tat retaliatory tariffs that is happening with US and China. So, but India, on the other hand, can rest easy, right? For a 90-day pause, you get on the 26%. It's 145% on China, 10% on India. Certainly, India benefits there, right? And markets did rejoice the day after the tariffs were rolled back. But the question we need to ask ourselves is whether this could be the start of yet another sustained rally, or whether it's simply a one-off and markets come crashing down to earth, soon. The answer, to be fair, is actually a bit of it's mixed. Actually, I can't really give you an answer. It's not a straightforward yes or no question. There is positives, there are negatives. So let's start with the positive news. With the tariffs rolled back, Indian exporters can now relax. The 90-day deferral is viewed as a significant relief, especially for sectors like shrimp, textiles, and MSMEs, which would have been hit the hardest by the higher tariff rate. Exporters, represented by the Federation of Indian Exports Organization, or FIEO, emphasized that the pause provides a vital window for diplomatic engagement and fast-tracking trade talks with the United States. Keep in mind, India, thanks to PM Modi being one of the first foreign leaders to visit President Trump since inauguration, has the added advantage of being very much at the front when it comes to sorting out a trade agreement with the United States. In fact, the Indian government is pushing to finalize the first phase of a bilateral trade agreement with the United States by fall 2025 or by autumn 2025, aiming to boost the bilateral trade to $500 billion, or $500 billion by 2030. Commerce and Industry Minister Piyush Goyal last week assured exporters that negotiations are progressing with urgency, but without undue haste, seeking the right balance for India's interests. What the 90-day pause has also done, thanks to the effective 145% tariffs imposed on China, has for the time being made Indian goods relatively more attractive in the US market. And Indian exporters are taking full advantage of this. Shrimp exporters, for instance, who face an effective customs duty of 17.7%, are preparing to ship large volumes to the US, with previously delayed consignments finally now moving forward. There is also another argument that the excessive tariffs on China could also open the door for more manufacturing to come to India as US companies diversify. However, this to me, if you really ask me, remains a long shot because for two reasons. First, the supply chain in China is it's no easy feat to replicate that. It's taken decades to reach the level it is today, and it is so complex that all the talk of US being independent from Chinese factories is far-fetched, to say the least. Okay, it has taken a lot of, it is not, again, nope, not a one switch. It's not a switch on, switch off thing. It's taken decades to kind of build the complex supply chains, especially for companies like Apple. So it's not like, oh yeah, we'll just move to India and Vietnam. It's not, to say that the US would be, it's super far-fetched, to say the least, at least for now. The other reason is, let's say US companies do diversify. Would regulations in India allow such a dramatic shift in the manufacturing landscape? I mean, India is already part of the China plus one strategy for many Western countries, but it is highly unlikely, in my opinion, that India can usurp China as the global manufacturing hub anytime soon. The reason why India's manufacturing sector has not grown so rapidly as those in other Asian countries is mainly due to structural issues, especially in land and labor reforms. For instance, Indian factories face restrictive building regulations that limit the amount of usable land for co-manufacturing activities. High minimum requirements for setbacks, open spaces, and parking, combined with low maximums for building height, create artificial land scarcity, inflate costs, and reduce productivity. These regulations force factories to dedicate a significant portion of their land to non-productive uses, raising construction costs and rents, and making it harder to scale up operations or create jobs. I mean, it's just one example, but rather a fundamental one on why more work needs to be done for India to be the next global hub in manufacturing. And this cannot be achieved in the next 90 days. So while work needs to continue to ensure that the country does become a global manufacturing hub, eventually, in the immediate future, within the 90 days period, the focus needs to be to ensure that a bilateral trade agreement with the US is done and dusted, one that ensures that the country doesn't get hit with the 26% intended tariff at the end of the 90-day period. According to Moody's latest report, should this 26% reciprocal tariff be fully applied after the 90-day pause, GDP growth is expected to fall by 30 basis points in 2025 and is expected to come in at 6.1%. Now, while 30 basis points may be marginal for 2025, the consequences of the reciprocal tariffs on 2026 GDP growth and beyond is likely to be negative as well. So the sooner the BTA is finalized, bilateral trade agreement is finalized, and the sooner India can avoid any further damage, the better it would be for the future, for its future growth trajectory. Investors' focus going forward should be on how the domestic economy fares and on how fast the bilateral trade agreement can be achieved. And if one looks at domestic consumption, then there's a lot to be cheered for, thanks to the latest moves made by the Reserve Bank of India. RBI's Monetary Policy Committee, in its first meeting of FY 25-26 last week, unanimously decided to cut the policy repo rate by 25 basis points, bringing it down to 6% from 6.25%. It marks the second consecutive rate cut in 2025, following a similar move in February, and signals a clear shift in the RBI's policy stance from neutral too accommodative. Now, the shift in the policy stance indicates openness to further rate cuts if economic conditions warrant that. This move is intended to provide additional support to growth, especially as global trade tensions and US tariff hikes create new headwinds. The RBI reaffirmed its commitment to maintaining ample liquidity in the financial system as well, having already injected nearly 7 lakh crores through various instruments such as bond purchases and forex swaps. This dramatic growth injecting policy decisions by the Reserve Bank of India comes at an opportune time, in my opinion. And I'm not talking just about the tariff impact. Okay, the RBI revised its real GDP growth projection for FY 25-26 to down to 6.5% from 6.7%, reflecting increased downside risk from global trade disruptions and tariff related uncertainties. But there's a lot more reasons, in my opinion, for investors to be optimistic. Inflation has certainly moderated and is expected to continue its downward trajectory. Same cannot be said in the US. The central bank expects CPI inflation to remain around 4%, supported by lower food and crude oil prices. Now, the improved inflation outlook provides room for further monetary easing if needed. Moreover, some of the indicators do show that growth is indeed slowing down. For instance, India's industrial output growth last week, as which is measured by the Index of Industrial Production (IIP), decelerated sharply to 2.9% year over year in Feb 2025, and it marked a 6-month low and a significant drop from the revised 5.2% growth recorded in January. This slowdown was also broad-based, unfortunately, across all major sectors, call it manufacturing, mining, and electricity. When you combine this with the projected tariff-driven GDP growth slowdown and the liquidity issues faced by banks thanks to slowing deposits, it would have been a nightmare had the RBI not gone for a growth focused move or not gone for a shift in the policy stance and so on and so forth. So it would have been an absolute nightmare for Indian investors. So what the RBI has done is actually phenomenal, and it gives Indian investors a lot of reasons to be optimistic, in my opinion. Bottom line, as I wrap up the segment, Indian investors have a lot to cheer thanks to a 90-day tariff pause, which buys officials more time to fast track the bilateral trade agreement with the United States. At the same time, RBI Governor Sanjay Malhotra and company are taking all the right steps to ensure that growth is revved up once again and there is sufficient liquidity in the financial system, which would allow banks to lend and drive the next capex cycle. Don't get me wrong, the tariff-related uncertainties are far from over, and expect the Indian markets to continue to be volatile going forward as they follow the steps of what's happening in Europe and US as well. But when you see that structurally moves are being made to ensure the long-term growth story remains intact, these volatile periods, ladies and gentlemen, in my opinion, should make for incredibly amazing buying opportunities. On that note, already got the notebook ready. That can only mean one thing. Let's head to the final segment, Dr. Dissects, where yet another name that has been absolutely pummeled in recent weeks goes under the microscope. A name that is getting attractive with each passing day, in my opinion, because of being a market leader and also an AI beneficiary. Name I'm talking about is, of course, Adobe, ticker ADBE. Now, Adobe reported its Q1 earnings last month, and overall, the company had a very strong start to the year. More specifically, the company generated record revenues in the first quarter, which came in at $5.71 billion, up 10.3% year over year, and beating analyst estimates by $52.4 million. Non-GAAP diluted EPS came in at about $5.08, up 13.4% year over year, and beating analyst estimates by 11 cents. The company's remaining performance obligations, or RPOs, came in at $19.7 billion, which represents a year-over-year growth of 12%. Investors have to take note that while the RPO growth rate was strong, it did decelerate compared to the previous quarter when the year-over-year growth was 16%. Now, management announced the company will now disclose subscription revenue under two new groups: business professionals and consumers, which will contain all the subscription revenue from Document Cloud, Acrobat subscription revenue in Creative Cloud, and Adobe Express subscription revenue in the Creative Cloud. The second segment being the creative and marketing professionals group, which will contain all subscription revenue from digital experience as well as all the remaining subscription revenue from Creative Cloud. In the current quarter, both these groups saw their revenue growth in double digits. The company reaffirmed its FY25 guidance on the back of a strong Q1 performance, which is now projected, which is basically projected revenues expected to come in between $23.3 billion and $23.55 billion, and projected non-GAAP diluted EPS should expect to come between $20.20 and $20.50. The reaffirmed guidance, however, fell shy of the consensus estimate, as a result of which the stock tanked nearly 14% post its earning release. The stock is down more than that year to date, and in the last 1 year, it's down more than 30%. I mean, it's been, and it's like that's why I started by segment by saying Adobe is getting absolutely pummeled. Now, I'm not here to just discuss the earnings numbers. I'm also here to talk about what did we learn from the earnings report, right? And one of the main takeaways from Adobe's Q1 report was the new metric that was introduced by the company, which represents the standalone AI-driven ARR. This metric came in at $125 million. And while this is a fraction of the $5.71 billion in overall revenue that the company generated for the quarter, it was a sign that the company was making progress with respect to monetizing its AI tools. Furthermore, management during the Q1 earnings call announced that they expect this metric to double in the next 9 months, which is yet another positive progress, in my opinion. Now, I'm not going to talk about a bull case on Adobe purely on this metric, given that it doesn't have any material impact at this stage. To me, what was encouraging to see was the accelerated adoption of Adobe's products, which are integrated with AI tools despite the company raising prices. For instance, while the company launched a free Photoshop app for the iPhone last month, it also raised subscription prices for a range of products. These include a $5 increase to the subscription price for 20 gigabytes of Photoshop, a $2 price increase to the subscription of Lightroom, and a $10 increase to the monthly subscription price of Substance 3D. Despite these price increases, the rate of adoption has not slowed down one bit, as evidenced by the double-digit revenue growth seen in both the business professional and consumer segment and the creative and market professional segment. Furthermore, one of my concerns was the lack of urgency shown by the company in recent times when it comes to monetizing the generative credits, which I believe to be a significant growth driver of AI monetization. This changed last month when the company announced two new Firefly, which is Adobe's flagship tool, Firefly plan offerings, the Firefly Standard and the Firefly Pro, both of which contain the Adobe's latest video offering, the Firefly Video Model. Now, Firefly Standard is priced at $999 and comes with 2,000 video per audio credits per month. And Firefly Pro is priced at $29.99 and enables access to 7,000 video audio credits per month. On top of this, a brand new Firefly Premium plan is also set to be launched very soon, which targets professionals to generate video content regularly. Now, the company has steadily shown that there has been a strong demand for Firefly, as evidenced by the continued strength seen in both the document and Creative Cloud segments in recent quarters. Even in the current quarter, the company generated $17.6 billion in digital media ARR, which represents a year-over-year growth of 12.6%. What was bothering me was there was a lot of freebies offered by the company to boost adoption of its AI tools, which, despite boosting monthly active users every quarter, never really contributed to the company's top and bottom lines. With the announcement of Firefly Standard and the Firefly Pro plans, both of which monetize the company's generative credits, the company has finally outlined a proper concrete roadmap to monetize its AI offerings. Add to this the one Adobe offering, and the path to AI monetization looks far stronger. These plans are not going to bring about an overnight transformation of the company's growth trajectory, especially in the current climate. However, for long-term investors, this is the kind of evidence that should reaffirm their faith that the company can benefit from the AI revolution. Notebook, pen ready. That can only mean one thing, valuation. So let's talk about valuation. I'm going to put down Adobe. We are talking Adobe, right? As mentioned earlier, the company reaffirmed its FY25 guidance, which means that non-GAAP diluted EPS, non-GAAP diluted EPS should come between $20.30 and $20.50. Okay, $20.30 and $20.50. Now, the company was expecting non-GAAP diluted EPS to come in between $4.95 and $5 in Q1. However, actual EPS came in at $5.08, exceeding the high end of its Q1 guidance by 8 cents. Now, the company has a history of providing conservative guidance. In the last 5 quarters, it has comfortably beat the high end of its own guidance on average by 2.04%. And if one takes FY24 as a whole, then the magnitude of the beat was 2.33%, further demonstrating the conservative nature of Adobe's management when it comes to guidance. And last time I talked about Adobe, I said if one takes the last 5 years, then the company has on average beaten analyst EPS estimates by 0.75%. Now, despite Adobe's track record of issuing overly conservative guidance, I'm going to focus on the analyst consensus rather than the company's own guidance and stick to my previous assumption that the company would beat the analyst consensus by 0.75%. Now, the consensus estimate for FY25, given the macro climate, has actually dropped to $20.39 from $20.52. So Adobe's basically 2030, 2050 is what the company was expecting, but the consensus estimate has now gone down to 2039 from 2052. 2052, I've just scratched it off, and it's 2039 now. So a beat by 0.75% would imply a projected FY25 EPS of $20.54, slightly lower than my previous estimate of 2067, but implies an earnings growth of 11.5% year over year. So 2054 is the assumption, and that implies a growth rate of 11.65% year over year. Okay. Now, the projected earnings growth for FY25 is marginally lower than its long-term earnings growth of 12.71%. For FY26, however, I'm going to assume the company's long-term earnings growth of FY20 of 12.71% under the assumption that the company will start to generate meaningful growth from its AI offerings, and under the assumption the macroeconomic uncertainty that has been negatively affecting the software names would eventually subside. Now, according to Seeking Alpha, Adobe currently trades at a forward price to earnings to growth, so the forward PEG ratio of 1.16, significantly lower. So forward PEG ratio of 1.16, significantly lower than the industry median of 1.39 and below its 5-year historical median of 2.15. So this is Adobe. This is median. So it trades below both. So 1.16 is where it currently trades. 1.39 is the industry median, and 2.15 is Adobe's 5-year historical average forward PEG. Now, even let's say a forward PEG of 2.15, forward PEG ratio of 2.15, and a projected FY26 earnings growth of 12.71%, Adobe should be currently trading at a price to earnings of 27.3 instead of the 16.5 multiple that it's currently trading at, which implies that the stock remains significantly undervalued at current levels. Even if one takes the sector median of 1.39, then the forward price to earnings based on FY26 EPS growth should be 17.7 times, which once again suggests that it remains undervalued. Finally, under the assumption that even in FY26, the projected earnings growth would be the same as FY25, which is 11.5%, then Adobe should be trading at a forward price to earnings between 16 times and 24.7 times. Under all these scenarios, ladies and gentlemen, the stock at current levels remains undervalued. Now, when you take all these scenarios that I talked about, different PEG ratios, different price to earnings ratio, all of that, the price target ranges from 366 to to 632, and with an average price target of 493. And that's my price target for the company, which, while lower than my previous price target of $606, still represents an upside of 41% from current levels. Price target is 493. It's about, price ranges from 366 to 632, price target 493, 41% upside from current levels. Now, despite the significant upside from current levels, Adobe has very weak momentum, as evidenced by the C rating on Seeking Alpha's momentum scale. As such, while I am maintaining a buy, so let me put that way, I'm maintaining a buy rating on the stock, price target 493, buy rating on the stock, 41% upside potential. I would strongly recommend a dollar cost averaging strategy while building a position in the name. I already have a very small position in Adobe. I'm just waiting for the noise to subside a little bit more before adding to my existing position, and I most certainly would be doing it dollar cost averaging for sure. Obviously, when I make a bull case, I also point out the risk factors. And the main risk factor to my bull case is the potential for a slowdown in the adoption of the company's products, AI or otherwise, owing to an overall slowdown in the economy. Well, this factor, in my opinion, does not affect the company's long-term prospects. This could be a significant headwind in the medium term. The other risk factor remains the overall monetization of AI. While the $125 million ARR for its standalone AI business is strong, it represents a drop in the bucket when compared to its overall revenues. Even doubling it, which management expects to achieve in the next 9 months, it isn't going to be significant. During the earnings call, management was vague regarding the timeline of when this metric would be material to the top and bottom lines. While I do remain optimistic about the company's ability to grow this metric over the long term, short-term headwinds do remain, especially when one factors in the number of freemium apps such as Canva that compete with Adobe. Any slowdown in the pace of AI monetization would be a significant headwind to my bull case. Bottom line, Adobe had a very strong start to the year with a beat on both the top and the bottom line estimates. However, despite this, the company's stock tumbled nearly 14% following its earnings results on account of a softer than expected guidance. The sell-off made no sense to me whatsoever, as this is a company that has a history of providing overly conservative guidance every single quarter. Once investors ignore the noise and focus on the company's future plans, and the fact that the company has finally capped its generative credits and is planning to monetize them through the Firefly Standard and the Firefly Pro offerings should be music to the investors' ears. Furthermore, the company announced that its standalone AI-related ARR amounted to $125 million, and the company plans to double this metric in the next 9 months. While this figure is a drop in the bucket compared to the company's overall revenues, the fact that there has been a strong degree of adoption of its products with AI offerings suggests that the company has the necessary tailwinds to grow the number in the coming quarters. The valuation at current levels does remain compelling. However, given the weak momentum and the overall negative sentiment towards software names, a dollar cost averaging strategy is recommended today. Adobe's AI-driven long-term prospects, in my opinion, appear to be stronger again, thanks to the management finally having the foresight to monetize its generative credits. That's all the time I have for you this week. Oh my God, time does fly. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttamvinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. I will see you next week, hopefully Tuesday, same time next week. Until then, ladies and gentlemen, stay safe, enjoy the tariff roller coaster ride, and make some money.